It happened so fast most people didn't even notice, and that alone should make you pause. Because when rules that affect every bank account in the country are passed in less than 24 hours, it's never random, it's never casual, and it's never for no reason. While headlines were busy arguing over politics and distractions, lawmakers quietly approved a new banking rule late at night. Regulators signed off before sunrise, and by the time markets opened, the clock was already ticking toward Monday. This wasn't debated for weeks on television. There were no town halls, no public explanation, just a sudden rule change that banks must follow immediately. And the speed tells us everything we need to know. When financial systems are stable, rules move slowly, but when pressure builds beneath the surface, decisions accelerate because the goal is not discussion, the goal is containment. To understand why this happened and what it means for you, we need to zoom out. Because this rule didn't appear overnight. It was the final move in a chain reaction that's been building for years. At its core, the modern banking system runs on confidence, not cash. Most people assume their money is sitting somewhere in a vault waiting for them, but in reality, banks operate on fractional reserves, meaning only a small portion of deposits exist as liquid cash, while the rest is lent out, invested, or pledged elsewhere. This works beautifully as long as everyone believes the system is solid, but once trust wobbles even slightly, the math breaks down fast. Over the last few years, that wobble has been getting harder to ignore. Interest rates rose at the fastest pace in decades, bond prices collapsed, unrealized losses piled up quietly on bank balance sheets, and suddenly institutions that looked healthy on paper were sitting on hundreds of billions in hidden losses. In the United States alone, regulatory filings showed unrealized losses exceeding $600 billion at their peak, mostly tied to long-duration government bonds purchased when rates were near zero. These weren't speculative bets. They were considered the safest assets on Earth until the environment changed. Now add to that the behavior of depositors. When rates were low, people didn't care where their cash sat. But once money market funds began paying 4 to 5% while banks offered near zero, capital started moving. Trillions of dollars flowed out of traditional deposits and into higher-yielding alternatives, shrinking bank funding bases in real time. This is why we saw sudden bank failures that seemed to come out of nowhere. They weren't random accidents, they were stress fractures finally becoming visible. Regulators responded with emergency backstops, special lending facilities, and quiet guarantees, but those were temporary patches, not long-term solutions. What was missing was a rule that could force banks to rebalance their risk instantly, even if it hurt in the short term. That's where this new rule comes in. Passed in under a day, it targets how banks classify, value, and fund their assets. Without diving into legal jargon, the essence is simple. Certain assets that were previously treated as safe and stable now require more capital backing, and some liabilities that were considered flexible are now being locked into stricter frameworks. In plain language, banks are being told they can no longer pretend that long-term losses don't matter just because they haven't been realized yet. This aligns with global regulatory pressure, particularly the final phase of Basel III reforms, sometimes called the Basel III Endgame, which aims to make banks hold more high-quality capital against potential shocks. While the official explanation focuses on resilience and stability, the timing reveals urgency. If this were merely housekeeping, it wouldn't start on a Monday with virtually no adjustment window. So why Monday? Because markets reset at the start of the week, and implementing changes then minimizes immediate volatility while maximizing compliance. Banks don't have the luxury of waiting. They must adapt instantly, adjusting balance sheets, shifting collateral, and in some cases, reducing exposure. That process can trigger ripple effects across lending, credit availability, and even precious metals markets. When banks need to shore up capital quickly, they often reduce lending or sell liquid assets, which can tighten financial conditions even if interest rates remain unchanged. This is why such rules matter not just to bankers, but to households, businesses, and investors alike. Think of the system like a massive suspension bridge. For years, engineers noticed small cracks forming, not dangerous on their own, but indicative of stress. Instead of closing the bridge for a full rebuild, they reinforced key supports overnight to prevent collapse during rush hour. Drivers still cross the bridge, but the weight limits are now stricter, and heavy trucks may need to take another route. In financial terms, those trucks are risk-heavy assets, speculative lending, and leverage that no longer fits within the new constraints. The bridge stays open, but movement changes. Some sectors slow down, others reroute, and a few feel the pressure immediately. This also helps explain why precious metals keep entering the conversation whenever banking rules change. Gold and silver are not someone else's liability, they don't rely on a counterparty's promise, and they sit outside the banking system entirely. When regulations tighten and trust is subtly questioned, capital often seeks assets that require no regulatory interpretation. This doesn't mean metals skyrocket overnight, but historically, periods of financial tightening combined with regulatory urgency tend to increase long-term demand for tangible stores of value. Central banks themselves have been signaling this shift. With record gold purchases over the last 2 years, particularly from emerging economies looking to reduce exposure to dollar-based systems. But before assuming this rule is either catastrophic or purely protective, it's important to understand what it does not do. It doesn't freeze accounts, it doesn't confiscate deposits, and it doesn't immediately collapse banks. What it does is force transparency and discipline at a moment when both are in short supply. For everyday people, the effects show up indirectly, through tighter credit standards, slower loan approvals, reduced risk appetite, and more cautious financial institutions. It's subtle at first, but over time, these shifts shape economic behavior. Businesses delay expansion, consumers think twice about debt, and investors reassess where safety truly lies. The speed of passage is the real signal here. When something moves this fast, it's because regulators believe the risk of waiting is greater than the risk of acting. History shows us this pattern clearly. In 2008, emergency measures were rolled out over weekends. In 2020, entire financial backstops were created in days. Each time, the public explanation came after the fact, not before. This rule fits that pattern not as a panic button, but as a preemptive lock on a door regulators don't want forced open. The question isn't whether the system is about to collapse, but whether it's entering a phase where stability must be enforced rather than assumed. As we move forward, R&D, the real impact will be revealed not in press releases, but in behavior. Watch lending standards, watch bank earnings calls, watch liquidity facilities usage, and watch how capital flows respond. Rules don't exist in isolation. They shape incentives, and incentives shape outcomes. Monday is not the end of the story. It's the beginning of a new operating environment for banks, investors, and anyone whose financial life depends on a system built on trust, leverage, and timing, because the real consequences of this new banking rule don't arrive with a loud announcement. They unfold quietly through balance sheets, lending desks, and internal risk meetings that never make the news. And that's precisely why understanding this phase matters more than the initial shock. Once the rule takes effect, banks immediately have to ask a hard question they've been postponing for years: how much risk are we actually carrying if today's market conditions don't improve? For institutions sitting on long-dated bonds purchased when yields were near historic lows, the answer is uncomfortable. Those assets may still pay out over time, but under the new framework, the paper losses they represent can no longer be brushed aside as accounting noise. They now demand real capital to back them, and capital is not infinite. When banks need more capital quickly, they have only a few levers to pull, and none of them are painless. The first lever is lending. Credit is the lifeblood of modern economies, but it's also one of the fastest ways banks can reduce risk. By tightening lending standards, raising minimum credit scores, increasing collateral requirements, or simply saying no more often, banks shrink their exposure without selling assets at a loss. We've already seen early signs of this behavior. Surveys from the Federal Reserve have shown a steady tightening of lending standards across commercial and consumer loans over the past several quarters, and this rule accelerates that trend. For small businesses, that can mean delayed expansion or higher borrowing costs. For consumers, it can show up as tougher mortgage approvals, reduced credit limits, or higher interest rates, even if central banks pause rate hikes. The rule doesn't change interest rates directly, but it changes how banks respond to them. The second lever is asset sales. Banks can sell bonds, equities, or other liquid holdings to free up capital, but selling into a stressed market often locks in losses. This is where timing becomes critical. If many institutions try to do this simultaneously, prices fall further, creating a feedback loop that regulators are desperate to avoid. That's why the rule was paired with existing liquidity facilities, allowing banks to borrow against certain assets instead of dumping them immediately. Think of it like a pressure valve. Regulators want banks to feel the constraint, but not trigger a cascade. Still, the presence of a valve doesn't eliminate pressure, it just manages it, and markets are exceptionally good at sensing pressure even when it's hidden. The third lever is behavior toward depositors. While the rule doesn't touch individual accounts, it influences how banks compete for deposits. Deposits are considered stable funding, and in a world where capital requirements are tighter, stable funding becomes more valuable. This is why some banks may raise deposit rates selectively, targeting larger or longer-term balances, while others may introduce new account structures that encourage customers to keep money parked rather than moving it freely. From the outside, this looks like routine product adjustments. From the inside, it's a strategic response to regulatory math. The irony is that while depositors are often told their money is safest when left untouched, the system itself is now incentivized to hold on to that money more tightly. All of this leads to a broader question. If banks are being forced to act more conservatively, where does the excess capital go? Historically, when financial institutions pull back, capital doesn't disappear, it migrates. Some flows into government securities, reinforcing the demand for sovereign debt despite concerns about deficits. Some flows into money market funds, which have already ballooned to record levels above $6 trillion. And some flows into hard assets that sit outside the banking system entirely. This is where precious metals re-enter the picture, not as a speculative frenzy, but as a structural. DGE. Gold and silver have served this role for centuries because they don't rely on regulatory interpretation, counterparty performance, or balance sheet classifications. An ounce of gold is not affected by a new rule passed overnight. It's important to separate hype from history here. Precious metals don't move in straight lines, and they don't respond instantly to every regulatory change. But if you look at periods of sustained financial tightening, regulatory reform, and capital constraint, metals often perform well over the medium to long term. After the Basel III liquidity coverage rules were introduced, gold began to be recognized more formally as a high-quality liquid asset by some regulators, a subtle but meaningful shift. Central banks took notice. Over the last 2 years, official sector gold purchases reached levels not seen since the mid-20th century, with countries like China, Turkey, and India steadily increasing reserves. This isn't coincidence, it's preparation. Silver occupies a slightly different space. It's both a monetary metal and an industrial input, used in electronics, solar panels, and emerging technologies. That dual role makes it more volatile, but also more sensitive to shifts in monetary confidence and industrial demand. When banks tighten credit, industrial growth can slow, but when monetary trust erodes, silver's monetary aspect tends to shine. This push and pull is why silver often lags gold initially, then moves aggressively once broader. Trends become clear. For investors watching this rule, the key is not day-to-day price action, but structural alignment. Are incentives pushing capital toward or away from the banking system? Right now, they're pushing caution inside the system and optionality outside it. Another overlooked consequence of rapid regulatory change is psychological. Markets don't just react to numbers, they react to signals. Passing a major banking rule in under 24 hours sends a message that regulators see something they don't want debated publicly. Even if the underlying issue is manageable, the signal alone can change behavior. CFOs become more conservative, investors demand higher risk premiums, and analysts adjust models to account for greater uncertainty. This is how slowdowns begin, not with crashes, but with caution spreading quietly. It's like driving through fog. You don't stop immediately, but you slow down, increase following distance, and become less willing to take risks. Multiply that behavior across millions of economic actors, and momentum fades. Critically, this rule also intersects with government finance. Banks are major buyers of government debt, and if holding that debt becomes more capital-intensive, demand dynamics shift. That doesn't mean banks stop buying treasuries, but it does mean pricing matters more. Yields may need to remain higher to attract buyers, which feeds back into borrowing costs across the economy. This creates a delicate balancing act for policymakers. They want financial stability, but stability often comes at the cost of growth. The faster the rule was passed, the more likely regulators believe that short-term growth sacrifices are preferable to long-term instability. For individuals watching all of this unfold, the challenge is separating fear from foresight. Panic leads to bad decisions, but ignorance leads to vulnerability. Understanding how rules shape incentives allows you to anticipate second-order effects. If credit tightens, cash flow matters more. If volatility increases, diversification matters more. If trust becomes a variable rather than a constant, assets that don't depend on trust become more attractive. None of this requires extreme action. It requires awareness. The system isn't ending, it's adjusting, and adjustments always create winners and losers depending on preparation. As Monday arrives and the rule becomes operational, headlines may remain quiet, but the machinery beneath the surface will be moving. Compliance teams will be recalculating ratios, traders will be adjusting positions, and executives will be making decisions that ripple outward over months, not days. This is the phase where nothing dramatic appears to happen, yet everything begins to change. To understand where this path ultimately leads, we need to look ahead, beyond immediate adjustments, into how sustained regulatory pressure reshapes financial behavior, capital allocation, and personal strategy, because the final impact of his rule will not be measured this week or this month, but over the coming years, and it will end with the word. Word travels slowly when change is structural rather than dramatic, and that is exactly how the final phase of this new banking rule will reveal itself. Not through a single headline event, but through a gradual reshaping of incentives that alters how money moves, how risk is priced, and how people relate to the financial system over time. Once banks adjust to the immediate requirements, the deeper effects begin to surface in strategy rather than compliance. Institutions start asking not just how to meet the rule, but how to operate profitably within it. That shift is where long-term consequences are born, because it determines what kinds of activity are rewarded and what kinds quietly disappear. One of the first changes typically appears in the structure of banking itself. Smaller and mid-sized banks often feel regulatory pressure more intensely than large institutions, not because they are riskier by nature, but because they have fewer resources to absorb compliance costs and capital constraints. Historically, periods of tightened regulation have led to consolidation. Stronger banks acquire weaker ones, regional banks merge to share capital burdens, and the system becomes more concentrated. This doesn't happen overnight, but over several years, the number of independent players shrinks. For consumers, this can mean fewer choices and less competition. For the system, it means that the institutions deemed too important to fail become even more central, reinforcing a paradox where stability relies on entities that cannot be allowed to collapse. At the same time, financial activity doesn't simply vanish when banks pull back. It moves elsewhere. Shadow banking systems, private credit funds, and non-bank lenders tend to expand when traditional banks tighten. These entities are less regulated, more flexible, and often willing to take on risks banks no longer can. Private credit markets have already exploded in size, surpassing $1.5 trillion globally, and this rule acts as fuel for that growth. Companies that once relied on bank loans increasingly turn to private lenders, often at higher costs and with stricter terms. This shift doesn't show up in consumer banking apps, but it changes the backbone of corporate finance, making the economy more dependent on markets that are less transparent and harder to stabilize in a crisis. This is where the rule's intention and its side effects begin to diverge. Regulators aim to make banks safer, and in isolation, they succeed. But by pushing risk outward, the overall system may not become less risky, just differently structured. It's like reinforcing one wall of a dam while water pressure builds elsewhere. The wall holds, but the stress redistributes. Understanding this helps explain why regulators often act decisively, yet cautiously, layering rules gradually rather than all at once. The fact that this rule was passed so quickly suggests they believed a redistribution had already gone too far to ignore. Another long-term effect emerges in how individuals think about savings and security. For decades, people were conditioned to trust that the banking system was a neutral utility, a place where money simply lived until needed. But repeated interventions, emergency facilities, and rapid rule changes subtly alter that perception. Even if deposits remain safe, the idea that access, yield, and stability are guaranteed begins to erode. This doesn't cause mass withdrawals, but it encourages diversification. People hold cash in different institutions, allocate some savings to non-bank vehicles, or explore assets that operate outside the traditional system. This behavioral shift is slow, almost invisible, but powerful over time. It's in this environment that precious metals take on renewed relevance, not as a reaction to fear, but as a response to complexity. When systems become more regulated, layered, and conditional, simplicity gains value. Gold's role as a store of value doesn't depend on earnings, interest rates, or regulatory ratios. Silver, while more volatile, offers exposure to both monetary hedging and technological demand. Neither replaces productive assets or income-generating investments, but they serve as anchors, assets that behave differently when rules, incentives, and trust structures shift. This is why discussions about banking rules and metals often intersect, not because one causes the other, but because both reflect how society manages uncertainty. Looking forward, the success or failure of this rule will not be judged by whether a crisis occurs next week, but by whether the system becomes less fragile over the next cycle. If banks rebuild capital buffers, price risk more accurately, and reduce reliance on short-term funding, the rule will be called a success. If, however, risk simply migrates further into opaque corners, the next shock may arrive from a place regulators weren't watching. History offers examples of both outcomes. After the reforms following the Great Depression, the system enjoyed decades of relative stability. After some post-crisis reforms in the late 20th century, new vulnerabilities emerged elsewhere. Regulation is not a destination, it's an ongoing negotiation between safety and growth. For individuals and investors, the practical takeaway is not to predict catastrophe, but to recognize transition. Transitions reward those who adapt early and penalize those who assume yesterday's rules still apply. This might mean prioritizing liquidity, avoiding excessive leverage, understanding where counterparty risk exists, and appreciating assets that don't rely entirely on financial engineering. It also means questioning narratives that insist everything is either perfectly safe or on the verge of collapse. Reality is usually more nuanced. Systems bend long before they break, and those bends create both friction and opportunity. As the weeks turn into months, this rule will fade from public conversation, replaced by new headlines and new distractions. But its influence will persist quietly in lending decisions, investment flows, and institutional strategies. Years from now, analysts may point back to this moment as a subtle turning point, not because it caused a crisis, but because it marked a shift in how seriously regulators treated accumulated risk. Passed in less than 24 hours, implemented on a Monday, and largely ignored by the public, it exemplifies how the most important financial changes often happen not in the spotlight, but in the background, shaping outcomes long after the news cycle has moved on. That is why understanding this rule matters, not because it demands immediate action, but because it signals a broader evolution in the relationship between banks, regulators, and society. The system is not static, and neither should our expectations be. Stability today is being engineered, not assumed, and engineered stability comes with constraints, trade-offs, and unintended consequences. Recognizing those dynamics allows you to navigate the landscape with clarity rather than confusion, preparedness rather than panic, and awareness rather than complacency, and with that understanding in place, we can step back and see the full picture clearly. This new banking rule, passed in less than 24 hours and activated almost immediately, is not about a sigh, a policy tweak, or an imminent collapse, but about a system under pressure choosing discipline over delay. It reflects years of accumulated risk from low interest rates, rapid tightening, and hidden losses, finally meeting regulatory reality. By forcing banks to hold more capital and confront risk honestly, regulators aim to strengthen the system, even if that means slower credit growth, tighter lending, and shifting capital flows. The real impact unfolds gradually, through behavior changes, market adjustments, and evolving trust. For individuals, the lesson is not fear, but awareness. Financial systems change quietly, and those who understand the signals can adapt intelligently, diversify wisely, and stay grounded as the rules of the game evolve around them.